Equity markets reflecting on services inflation, which is a little bit sticky. It's Friday, the day that records come to die. We've had 6 days in a row of rally. In the past 30 minutes, we're giving it back, down a tenth of 1% on the S&P 500. Intel is a car crash on the guidance. Gensler's got to do an awful lot to guide this market. You've got euro dollar pipping up by an eighth of 1% at 108.64. Did you really think Lagarde meant that she was going to go earlier than the summer yesterday? Oh, look, they got ticker tape at the NASDAQ today. That is very cool. Bright spring. They're a happy crew at the NASDAQ today. We're up on yields, up by a pip. The headline PCE comes in sub 3%, but it is the services part, which is the highest monthly change in 3 months. You'd hardly call it exorbitant, ticking up on the 10 years. And crude is down by half of 1%, 76.98 is where we trade at the moment. One stock that I mentioned, it is Intel, and the chip maker is sinking. You've got disappointing forecasts, to say the least, renewing uncertainty around this stock. Abigail Doolittle has the detail. Abby.
Well, Manus, we have this stock plunging worst day since October of 2021, and it's one reason that we have both the S&P 500 and the NASDAQ snapping a 6-day winning streak, because it is the biggest weight dragging on both of those indexes. So they actually put up a good quarter, but to what you just said, the outlook, especially for the first quarter, very disappointing. They're talking about $12.2 billion to $13.2 billion in revenue versus the estimate of $14.25 billion. So a pretty significant miss there. Profits 13 cents versus 34 cents. So more than a 50% haircut there relative to expectations. Now the chip maker's personal computer business is recovering, but demand in the lucrative market for data center chips is not so strong. In addition, they are contending with a slowdown in programmable chips and components for self-driving vehicles. They've also talked about getting into the foundry business. That seems to be stalling. There's not a lot of information there. All of this puts that turnaround that you were talking about, a fledgling turnaround, into question. We have at least one downgrade on the stock to a hold from a buy over at, I believe it is Raymond James. I'm just trying to pull that up right now. Needham, actually. And the stock up more than 60% into today over the last year. They need to put up more. They could not miss the outlook like this, and we have the stock again plunging on the day.
Yeah, and you've got their original customers designing their own chips, so it's a tough world out there. Abby, thank you very much. Let's stick with the earnings theme. Visa's robust results, they're being overshadowed by January's weak trends, but a more optimistic response to Amex. Simone Foxman has the details. Simone.
Yeah, Manus, the investors, at least this morning in early trading, seem to be more focused on the outlook than they are on the latest quarter results. We got news from both of these companies today. Visa actually performing a little bit better than expected in its last quarter, but some of these results and some of the trends that I was seeing in January may be related to some negative weather, kind of overshadowing the picture for the year. So it saw quarterly profit up 8% year on year. That was ahead of expectations. Revenue up 9%. But the CFO is saying that this was a short-term blip in January. However, Jeffrey's saying, steep acceleration for the year, low double-digit growth. We're going to need to see the company really come back from that after a slow start. Amex, however, missing estimates, but seeing a stronger outlook than anticipated, boosting its quarterly dividend as well. So maybe we're seeing some of the response there. From a macro perspective, though, both companies saying they see a very strong consumer. They're projecting that throughout the year with double-digit revenue growth. Also should be noted, Visa hit an all-time high yesterday, so maybe some of the responses, people just taking profits here, Manus.
Yeah, there's always that. Plus, I've yet to get an Amex card as well. I'm still got my Visa. Simone, thank you very much. Simone Foxman there. Let's turn to transportation. Norfolk Southern is missing their estimates for the fourth quarter, marking an end of what the CEO calls a challenging, transformational year. Isabel Lee is with me. Do the investors believe that? Not really at the moment.
Not really at the moment. Shares are lower, around 3%, Manus. It wasn't a good cycle for Norfolk Southern. The railroad operator reported a drop in operating income, and that's dragged by another $150 million last year that resulted from the derailment of their trains in Ohio. And the company also reported an adjusted EPS that was lower than estimates. They reported $2.83. That's slightly lower than the $2.87. Its railroad operating revenue also fell around 5%, as well as the merchandise revenue, which is around 1% lower. For the year, the company is targeting a revenue growth of about 3%. So maybe that's where the transformational part enters. On Thursday, we have some bad news. The company announced it's laying off 7% of its non-union workforce, and that's amid just a tough freight cycle. By some calculations, this would translate to around 330 people in their workforce. For now, Norfolk shares are down 3% in the past 12 months. It's also lower by 1%, Manus.
Isabel, thank you very much keeping a track of the earnings there. Excuse the pun. Let's turn to telecoms. T-Mobile's earnings missing the estimates. Despite strong gain in subscribers, Katie Greifeld has been tracking the mobile. Katie.
It's pretty much a mixed morning, I would say, for T-Mobile. You take a look at the shares right now, currently a little bit under pressure. You had fourth quarter EPS. It missed estimates. It came in at $1.67 in the quarter. Analysts had been looking for $1.91 there, so a bit light. And that's really overshadowing that good news that you mentioned on the subscriber front. T-Mobile, it actually added 934,000 phone subscribers in the quarter. That is well ahead of estimates. Analysts were expecting 886,000, and it also outpaces peers AT&T and Verizon, which also reported gains when it came to subscribers. While analysts are praising the growth and the quarter overall, they seem pretty rosy about this report overall. They did note that share buybacks did not meet expectations. You also had churn a little bit higher than expected. But to get into some of the commentary, you had Citi writing that while there were some, quote, bright spots and some wrinkles in this report, you know, more good than bad, you also had Morgan Stanley Simon Flannery noting the less than robust expected buybacks as mentioned, but he also wrote that he continues to see T-Mobile as leading the industry with significant share gain potential to come in the smaller markets. Maybe that's helping the stock rebound a little bit right now, currently down about 1%. We've been closer to about 2% lower pre-market, Manus.
Okay, Katie, thank you very much. HSBC's Max Kettner listening in to the roll call of results and the macro flow, but he delivers this warning with this. While it may be tempting to chase the latest all-time highs, we maintain our view of reverse Goldilocks. If anything, 2023 has taught us not to chase but to fade the trends. Max Kettner has never been one for the crowds, but I will challenge you. Good morning. How are you? Good to see you. So look.
Good morning, Manus.
Record after record on the equities. Credit spreads are on the tide. Strong U.S. growth. China stimulus. Tell me where the cracks are.
Yeah, look, I think the cracks are perhaps that inflation is a bit stickier than we thought, right? In fact, when we look year to date at the risk asset rally, it is not similar to what we had last year. Last year, right, it was almost enough that we had this tech-driven rally in U.S. equities and U.S. large caps, and that was sort of propelling everything higher, from emerging market debt to high-yield credit and high beta effects. When we look at those asset classes since the start of the year, well, the reality is when we look at emerging market debt spreads, they're up 20 basis points. High yield spreads are up 10, 15 basis points in the US. You know, when we look at things like EM local currency debt, that's down 2.5%. The Russell is down 2.5%. So it's really just those handful of stocks that are driving the gains. But under the hood, we are starting to see some of those cracks. And I would say it's perhaps that we're getting a little bit too comfortable with inflation completely disappearing. And on the other hand, we see that in the pricing, right? We see that, for example, short-dated inflation expectations in the US, they came down from sort of 2.70 down to 2% in the last 2.5, 3 months. We saw that when we look at, for example, global equity performance, compare that with earnings revisions. I would argue, look, even if the reporting season now is good, and even if what you guys were discussing just now, even if the guidance of most companies turns around and is actually much, much better from now on, most of that is now in the price, right? Most of that, even if earnings revisions do pick up, that is now priced in. The same thing goes for valuations. We know that PEs have gone up, but that was mostly really a function of lower yields and lower rates volatility, but that's been largely played out now. So I do question what is the catalyst up from here.
Okay, you question the catalyst up, which then makes me cautious about what I have in my exposure. My question is, do I de-risk from equity and take, you talked about the sort of the pop, slightly pop, I wouldn't call it a hectic move, Max, on high yield, but do I de-risk in equity and high yield and go for IG over high yield until there's better clarity?
Yeah, I think so. I think that's probably the right strategy. So you want to sort of hide out in short duration stuff, right? Short duration IG credit, particularly in the US, because bear in mind, the environment that we foresee, which we're sort of calling reverse Goldilocks, or call it bad news becoming good news, those sorts of backdrops, they typically argue for a stronger dollar, right? So if you're hiding out in shorter duration credit, for example, in US dollars, that tends to work quite well as a hedge. We do still think that energy prices can trend higher from here, right? So we're not bearish on all the risk assets per se. In fact, our view is not a classic risk off. It's the exact opposite.
And you and I spoke about this before. So maybe the slightly more challenging question to frame to you is this: how long do you think? How enduring will reverse Goldilocks be, Max? Max, do you think it's going to be a period of time, Manus, until I see rate cuts, stabilization, syncopated drop in inflation? Does reverse Goldilocks is it a front-loaded 2024 scenario plan?
Yeah, I think that's true. It's not going to be a view that will pan out throughout the entire 2024, right? Look at the last year, for example. You were just reading some of the stuff that we put out in a note this week. The fact is, when we look, for example, 12 months ago, people were playing US recession for a month or two, and then for 2 months we played banking crisis and credit crunch. And then for 2 months we played, debt ceiling and Treasury general account. Then we played Goldilocks for 2 months. Then we played higher for longer. Yields can never go down anymore, right? We played that for 3 months. And now we played for 2-3 months, we played the whole Goldilocks theme. And, just going through that from the last 12 months, it really taught us, look, probably this is not the environment anymore like it was in the 2010s where you want to chase those trends, but where you want to say, look, the next one is going to be perhaps exactly the opposite. And that's not going to take 6, 9, or even 12 months. It could easily be coming, snapping back very, very quickly, perhaps even next week, right? With some of the, perhaps there'll be some more disappointing news from the tech sector because the expectations are so high. Maybe the Fed does put some wording in around the easing of financial conditions that makes them a little bit uncomfortable, right? What about the quarterly refunding announcement on Monday, for example? What about non-farm payrolls, wage growth, right? Wage growth also on the employment cost index. So there's quite a few things that under the hood I think could be questioning that super dovish pricing now and the exuberant pricing in equities with regard to valuations and earnings.
Okay, so I hear you. I got the lines from the report. Hide out in a bit of cash, short-dated credit, and you like Japan equities and energy. So that is what you like. What is it that would cause you to rewrite the top line on the research note, which goes, prepare for reverse Goldilocks? What is it that backs that up? What is it that makes you rip that off and go, okay, I'm turning?
Yeah, I think one of the things that we really need to look at is sentiment and positioning. When we look, for example, at our sentiment and positioning indicators, yes, they have gone down. You've seen that also in survey-based sentiment. So you've clearly seen, I think, since the start of the year, talking also to our clients around the world, I think most clients on the discretionary side are sort of neutral, really trying to figure out what's going on. Is that rally going to broaden out? Is it going to broaden out into other asset classes, into the broader sectors within equities as well? Whereas on the systematic side, when we look at positioning of CTAs, of risk parity funds, of volatility target strategies, the reality is, on our measures, that is almost maxed out long. So frankly, all I need right now is I need a bit of a turn in shorter term momentum. And once that turn in momentum comes, then, those strategies, those systematic strategies really will turn very quickly from net buyers and buying pretty heavily to actually pretty heavy net selling, right? And that can go very, very quickly. And that really would be, for us, one of the triggers really on that reverse Goldilocks coming pretty quickly.
And then can I just take you to the other side of the barbell? What would be your greyest swan?
Yeah, I think especially for a view like ours, right? I guess the biggest risk is that the next couple of weeks, next couple of months, we're going to continue to see data like we had last week, right? Or even yesterday, when, GDP rises more than expected. You look at the number and your first reaction is, oh God, like, can't we see really 6 rate cuts this year with such a strong growth number? And then at second glance, you look at the inflation side and you're saying, it's great, right? We're back to target, on some measures even below that. So if that continues, if in the next couple of months, we're going to continue to see, better than expected growth, but inflation basically gradually going towards target without any kind of disruption, that I think it's basically Goldilocks on pretty much, the next couple of months, and it still then argues for tech and for AI and a continued rally across everything.
So before I let you go, what's the style of jacket? This is the full kind of very beautiful German tailoring, is it? What's the name on that?
It is underlying my Bavarian nature, that, man.
Bavarian nature. You just see Max somewhere near to you with what's the name of the thing you drink out of a stein, is it? Yeah.
Oh yeah, that is called beer, Manus. That is called beer.
Okay, this is going to descend. I'll see you soon. I'll see you in America for a beer soon. Max Kettner there with his reverse Goldilocks, but he's open to change. Coming up, wrapping up the big week of earnings.
LVMH is remarkable in that its fashion and leather goods segment added in incremental sales the entire top line of Tod's, Ferragamo and Burberry put together. That's just how much it grew on top of a very big base already.
The monster that is Louis Vuitton. Earnings season heating up. Next week, big tech on the deck. That conversation next on Bloomberg.
If we look at kind of scale, LVMH is remarkable in that its fashion and leather goods segment added in incremental sales the entire top line of Tod's, Ferragamo and Burberry put together. That's just how much it grew on top of a very big base already. So that is what has insulated its operational leverage relative to its peers. And I think that's also important in that many companies in the sector delivered outsized margin expansion in the wake of the pandemic.
That is a heck of a moat around one brand name in the luxury sector, showing signs of resilience. It is LVMH delivering better than expected results. Shoppers treating themselves to the brand's luxury handbags and clothes. Organic growth was monumental there. Simone Foxman is with us. So much for the aspirational shopper. They're not interested in them right now.
Yeah, it seems that the luxury shopper is carrying the day, and shares up the most since 2009 on the back of these results. Really reassurance for the street in the wake of some of these concerns about weakness in the high-end goods industry overall. Note that LVMH had hit a 14-month low yesterday, but fashion and leather, 9% organic growth in the fourth quarter. Wine and spirits expected to sink 7%, but then seeing an unexpected 4% surprise after 2 quarters of declines, especially on the back of that slowdown in the United States. So overall organic revenue growth up 10% year on year. The estimate had been for 8%. Management also hitting a very robust tone. A lot of analysts across the street noting that, confident in their 2024 despite some of the geopolitical and macroeconomic headwinds. The CFO also said, though, that they don't plan further price increases in 2024. Citi says this tone indicative of the idea that 2024 could be a smooth normalization rather than the difficult one that many had been anticipating. Able to weather those winds of U.S. slowdown, able to weather those winds of Chinese consumer, and that's why we're seeing that positive bump in shares today, Manus.
Yeah, you call that normalization with swag. Simone Foxman there on Louis Vuitton's numbers. From retailers to big tech, we get the results from 5 members of the Magnificent Seven next week. The preview, Katie Greifeld has the curtain raiser. Katie.
Manus, buckle up because we have a big week next week. In the coming 7 days, you have 108 companies in the S&P 500 taking the stage. That amounts to $16.8 trillion in market cap, making it the busiest week of earnings season. So let's name some names here, because on Tuesday you have Alphabet, you have Microsoft reporting, then you have Apple and Amazon on Thursday, as you can see on that calendar, and then Meta closes us out on Friday. And like you said, 5 of the Magnificent Seven just there alone. And traders will be watching to see if that group can overcome the ills of Tesla. The EV maker really whipped on earnings this week. That's adding to a 25% loss already in 2024 for Tesla. And the Magnificent Seven as a whole, it's managed to actually hold up despite Tesla's performance, but obviously the next few days are crucial to determining whether or not that dynamic is sustainable in the long haul. And don't forget, in addition to big tech earnings, we also have a Fed decision and a jobs report, so it's going to be a lot of fun, Manus.
Yeah, a heck of a lot of fun. Katie, thank you very much. Looking ahead to next week. For some of the sector price action, let's get back to Abigail Doolittle. Bit of a guess here. Maybe tech might be under pressure.
You're right about that. That, of course, is the worst sector on the day. On Intel having its worst day in more than 2 years. As a result, we have the S&P 500 actually looking at a small decline right now, the first time we've seen that in 7 days. To the upside, though, with consumer discretionary up 0.5%, Whirlpool, Tupperware, along with Tesla, all helping out there. As for the week, let's take a look at the best 2, and it's a little bit of a surprise here, actually, to me. Energy is the best sector on the week, followed by communication services, and then to the downside, we're looking at consumer discretionary. I think that has a lot to do with Tesla's fall yesterday, and then healthcare, a small decline. But on the week, Manus, we are looking at a 1% gain right now, at least, for the S&P 500.
Okay, keeping the dream alive maybe for the week. Abigail, thank you very much. Coming up, the market-moving events that will dominate your diary. That's next. record run up on these stocks is interrupted. Do you really want to take that much risk going into next week when you've got the Mag 5 reporting and nearly over $60 trillion worth of market cap hitting the tape next week? Do you want that risk on your book? Well, let me tell you what you do need to know to focus for the week. Tuesday it is Tech Mountain. Earnings come in from Alphabet and Microsoft. Wednesday, you have the Fed's decision and Chairman Powell's news conference. Guidance on the inflation and rates. The Bank of England, it's their turn on Thursday. And then more and more tech. Amazon and Apple and Meta earnings pile in. Finally, the crescendo of the week. The payrolls report with wages, jobs, and all you need to know about the health of the U.S. economy. It's Friday. We got there. Nothing quite broke. Perhaps interrupted on this equity rally for now. Countdown to the open Friday. That's it from me. This is Bloomberg.
We're 30 minutes into the U.S. trading day on this Friday, January 26th. Here are the top stories that we're following. Shake it off. Stocks fighting to go green, even as Intel's disappointing earnings report sends a shudder through chip stocks. And we'll get a read on restaurants and the state of inflation and climbing food prices with Michael Osanlu, the CEO of Portillo's, a national fast casual chain. And a worrying fiscal outlook. Former Treasury Secretary Robert Rubin warns that the U.S. is in a, quote, terrible place when it comes to its federal deficits. More in our Wall Street Week daily segment. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. And as I mentioned, you have an S&P 500 right now fighting and failing to go green. You can see we're down by less than 0.1%. We'll see how we settle up. You take a look at big tech having a much worse day, down about 0.5%. A lot of that coming back to those Intel results that we got a little bit earlier. And that leads me to the SOX index, of course, down by about 2.4% right now. Intel really taking a bite there and really leading the rest of the industry down lower. And I did want to highlight Spirit Airlines because that saga continues. You have JetBlue warning today that that merger deal could be terminated. That is sending Spirit shares down to the tune of about 16% or so. But let's go back to the SOX. Let's go back to Intel because Intel really taking a tumble today after delivering a disappointing forecast on yesterday's earnings call. Both sales and profits came in below Wall Street estimates, renewing doubts on a long-promised turnaround. For more on the chip maker, I'm pleased to say we're joined by Bloomberg's Jackie Davlos. And Jackie, it seems like it's the outlook here that's really spooking investors.
That's right, Katie. It overshadowed what was otherwise a very healthy report. You had sales projected to come in between 12.2 and 13.2 billion, but Wall Street was expecting 14.3 billion. That's over $1 billion miss at the middle range. And then you also had profits coming in at a projected 13 cents a share, but Wall Street was expecting 34. Now, there's a few factors that are responsible for the weaker guidance. And the first is Mobileye. Remember, that's the autonomous vehicle technology company that has reported it's going to see fewer sales this quarter and into the year, especially because you're dealing with a stockpile in that technology that's really rattling the industry broadly. But Intel is taking a hit there, in addition to a slowdown in its programmable chips unit. And then on top of that, they're baking in some slowdown, a little bit of weakness coming in from their core PC and from their core PC business. Now, Pat Gelsinger tried to allay some of these concerns on the conference call with analysts, saying that these headwinds were temporary and that he expects sales to really recover and see a positive growth over the course of the year. But as you can see, that's not really making much of a difference as we see the stock perform today.
Certainly, again, you look at Intel right now, really tumbling. Jackie, really appreciate the reporting there. That is Bloomberg's Jackie Davlos. And we'll get some more analysis from those Intel earnings with the CEO, Pat Gelsinger. He joins Bloomberg Technology at 11:20 New York time. Let's go back to these broader markets now and get some insight into Intel and the markets overall. We're going to do that with Chris Murphy. He is co-head of derivatives strategy over at Susquehanna. He joins us now. And I have to say, I mean, you look at the broader index, the S&P 500, it is lower right now, but you think about what we got from Tesla, what we got from Intel, and it seems that there's this resilience that's still sticking by.
Yeah, hey, Katie. Certainly a lot of resilience. I mean, I do think some of the economic numbers we've gotten the last couple days points a little bit, again, towards the soft landing. And one thing to keep in mind, especially during earnings season and what we're seeing in the market in general, is really low correlation among S&P components. So you have a situation where stocks are moving on their own specific earnings, merits, news, things like that. So you end up moving the components in different directions, but the actual underlying S&P ends up not moving that much. You know, like we're seeing today, we've had 5 straight all-time highs, but the reality is it's been very incremental moves higher. So that's kind of the backdrop we're looking at with the S&P.
Yeah, not a lot of fanfare and fireworks around these all-time highs, I got to say. But we started the week with Amy Wu Silverman from RBC, so I'm glad that we're closing it out with you. Amy told us that if you think about the big tech rally that we saw last year relative to what we're seeing this year, you're not really seeing the same scramble for upside call bids, et cetera. There isn't that same sense of FOMO in this market. Is that your read as well?
Yeah, absolutely. And that probably just means that as opposed to last year when people were underinvested and offsides in some of these tech names and trying to catch up via buying calls. Now they're pretty full in that area of the market. They might be a little bit under exposed in other things like small caps or energy or whatever else, but just in terms of the options market, what we're seeing there, it does seem to indicate that investors have their positions in the mega cap tech names. We're not seeing as much reaching for upside because people are offsides there.
And let's talk about where there is some reaching going on, because it's been really interesting to see the bid come back into Chinese equities, especially when you look through the lens of ETFs, for example. I keep a close eye on FXI. What are you seeing there? I mean, it seems like when it comes to Chinese equities, we saw this a couple years ago as well, people really trying to time the bottom, and maybe you're seeing that again now.
Yes, yeah, absolutely. I think part of it is trying to time the bottom, and then part of it is, once again, you got to think of where is the positioning. The positioning is certainly not in China. People have moved out of that sector. You can see very underexposed there. So you're seeing a lot of call activity. Now, we've seen it a number of times. Like you said, we see an uptick in call volume, only to see China move lower again. This time may be a little bit different. If you look back at a 1+ year chart, we are seeing the highest call volumes we've seen in a long time in that area. So, not necessarily a I'm super bullish on China read from the options, more of a I'm not exposed to China, and if it finally does actually rebound, then it's not another pump fake. I need to be there. So instead of buying the underlying, which I'm not sure about, I'm going to buy some upside calls. That way my exposure really ramps up if the stock ramps up.
And Chris, I want to switch gears a little bit here, because you live in the derivatives world. I live in the ETF world, and a really interesting trend that's emerged over the past year or so is just so much demand for covered call strategies, basically selling call options, et cetera. I'm curious to hear your perspective as someone who's watching this, what the impact and the ripple effects of the popularity of those types of strategies are on the overall volatility landscape.
Yeah, volatility selling has been more effective over the last couple of years. So obviously it's going to gain assets, and it's going to become a more popular trade. When we're seeing more volatility selling, that's obviously going to impact the broader market. If we step back and look at the whole correlation story again, very low correlation in the S&P, selling volatility on the macro level, maybe not getting as much bang for your buck, certainly as you were a year or two ago. I would be thinking more of selling volatility on a single stock basis. I think that's, more attractive. And then just to your point with ETFs or other vehicles for investors to be able to get exposed to short volatility, I think that's great to get that access. If you zoom back, long term, selling insurance, selling volatility, that's a profitable business. You think about the insurance sector in the broader economy. Over time, selling insurance it is profitable. Obviously, you have to be able to weather the occasional storms. So when we're looking at volatility buying, when we're recommending that to our clients, we're looking at that more on a tactical basis when things are getting what we think is too cheap. But over the longer term, selling insurance, selling volatility, it's something that's great that people have access to.
The insurance business, it's not a bad one. Chris, don't go anywhere, rather. You're sticking with us. But right now, let's take a look at some of the stocks moving right now, and especially some interesting sell-side notes that we've gotten today. Bloomberg's Bailey Lipschultz is sitting beside me. What's going on?
Yeah, Katie, starting with Coinbase, upgraded at Oppenheimer, talking about a number of catalysts on the horizon. Interesting comment, though, saying that the company and management are stronger than some people think, really calling out in part of this upgrade, stocks up 2%, the fact that it was down about 33% from a December 28th high. Obviously, getting a bit of a bid today as Bitcoin rallies. I know you're a crypto and cats fan. I don't know if your cats trade crypto, but that's part of the thing that we're seeing with Coinbase rallying this morning is just optimism about the entire space.
In certain jurisdictions, actually, cats are allowed to trade crypto. But what's interesting, I mean, it's getting upgraded now. I know that Coinbase has fallen to start the year, but it was up like 400% last year.
Yeah, huge rally. So you missed the boat, but then take advantage on the dip, I guess. The one thing you did call out, too, is that could potentially prevail in the SEC lawsuit. You have fundamentals maybe firming up with the spot ETFs now trading, and we're seeing some of those outflows from Grayscale, and that's one of the things that, according to analysts, is driving and propping up Bitcoin Bitcoin.
Well, there's definitely a divide in the analyst community as to whether spot Bitcoin ETFs are good or bad news for Coinbase. They report in a few weeks' time. But let's move on here because there was also a really interesting note out of Deutsche Bank.
Yeah, Deutsche Bank upgrading Snap, talking up ad outlook. That has been the big driver for why these shares are down. As you mentioned, as you look at it, Snap on a 12-month basis, pretty strong move up and to the right, but you have to keep in mind, it's down about 80% from a late 2021 high. So looking at this call from Deutsche Bank, basically saying that they see a positive outlook for advertising, talking up the upgrades that Snapchat is implementing, and saying that 2024 ad growth is expected to largely mimic the 2023 performance, and touting AI impact, which
Gotta
we
get
know,
that in there.
if you talk AI, everyone's going to be excited.
Yeah, it's going to be fascinating to see what the companies have to say. Of course, we're looking forward to Meta and Alphabet that reporting next week when we get there. But when we think about what's reported this week, of course, we had Visa yesterday, and it seems like that's being welcomed with open arms.
It was welcomed. It's down about 2% with great share price comes great expectations, I guess. Really calling out the weakness, according to analysts. The January trends really clouding those results. Again, quarterly and annually beating expectations, but seasonal weakness paired with weather weakness. People maybe when it's cold out not wanting to go bar hopping or buying those goods, and it does seem like that showed up. Some analysts saying that's more of a transitory risk, not really going to continue to play out in this quarter, but one reason that it's down. But again, closing at an all-time high yesterday, beating expectations. A 2% pullback isn't really anything to be too concerned about.
Context is important. Bailey, it's great to see you. Have a great weekend. That is Bloomberg's Bailey Lipschultz. And coming up, we'll keep the conversation going because U.S. consumers, they're still spending. American Express beating analyst estimates and painting a bright picture for 2024. We'll discuss the highlights of our interview with the Amex CEO next. This is Bloomberg. Well, it's a positive sign about the U.S. consumer. American Express out with earnings today, and the company said it's sticking to its long-term profit and revenue goals. It also forecast earnings for 2024 that topped analyst estimates. Bloomberg Technology co-host Caroline Hyde spoke to the CEO earlier today, and she joins us now. And I have to imagine he was in a pretty good mood.
He is still, Steve Squires. nearly always in a good mood. I have to say he's like an eternal optimist, but he's feeling really strong. He thinks the momentum that they saw, particularly in the third and the fourth quarter, that's just going to continue into the 2024 year in terms of the resilience of their client. Now, look, their customer base isn't the economy. It's not a direct reflection. It is the higher tier. So we are going to see better ability to pay down their debts. You are therefore seeing the fact that they're very in control of how much they're having to set aside in terms of credit losses. They're showing, though, that a consumer is still resilient. And really, he did feel positive about the momentum. I think we can show about what he said about the momentum of the spending within Amex. Notably, he said, look, yeah, we might have missed the odd consensus report for their fiscal fourth quarter, but that was because of Argentina. Remember, big devaluation, it hit a lot of the banks, and they're saying, look, that's the resilience of our business model. If we can take a $100 million hit in the last couple of weeks of our year and still post such strong results, I mean, I'm looking at revenue that climbed some 14% for the full year, he's pretty confident.
Yeah, you have to wonder how many businesses could take a hit like that and still do well there. And it's interesting, of course, this is a big week for the cards. We also had Visa coming out. Compare and contrast what we heard from Amex versus what we saw from Visa.
Well, there is some more concern about Visa in the longer term, and that's why you're seeing Amex's share price rise to a record high. And Visa, even though we saw a similar run-up like Amex in terms of their share price in the last quarter of the year, Visa did very well. We're now seeing some weakness, and I think overall Visa, we are seeing some of the investor base just being a little bit worried about the resilience of this fiscal January that they're seeing. They're already painting that maybe some of their own momentum has slowed down a bit. There was worry that some of that bad weather that we've seen leached into some of the desire for consumers to be spending. And remember, this is a slightly different consumer base. It isn't the very high end. It isn't a platinum card user. Visa has the whole breadth of a US economy, and we are more worried, particularly about the lower end. You just think about how the very high-end luxury companies still outperform but some of the others. So I think there is a little bit more of a concern about a Visa.
And Caroline, as you know well, every company has to talk about AI in this current...
They do when they talk to me for a technology show too.
Exactly, exactly. What did the Amex CEO have to say about AI?
So they've been doing this for years, decades, 15 years he's been using it in fraud detection and the like. But generative AI is the new play. Yes, they are investing in that, whether it be for the use of generating an itinerary, if you're going to be using Amex for travel, whether or not it's the way in which they're thinking of it within their cybersecurity. But I think it's notable that he's saying, from a jobs perspective, he's not having to make big job cuts. He never does. He's some more reorientation of his colleagues, as he calls them. But it is notable that he says, I don't see them eliminating positions per se, but I do see it limiting the growth of hiring. Look, if I can get a better customer experience on the Amex app using generative AI than I do a real person, then of course he's not going to have to hire so much into that part of the business model. So it is going to slow overall growth in hiring, I think, for him.
Fascinating conversation. Great to break it down with you. That, of course, is Bloomberg Technology co-anchor Caroline Hyde, and you can catch her in about 40 minutes or so. But for right now, let's welcome back Chris Murphy. He is co-head of derivative strategy over at Susquehanna. And Chris, obviously a huge week of earnings coming up next week. Let's start with one of the biggies, and that is Amazon. When you get down into the weeds of the options market, how are traders positioning for this one?
They want to buy the dip, but they want to be involved if it keeps moving higher. One options trade that stuck out, actually really two that stuck out to me this week. Just the near term, next week, call spread buyer. What are they looking for there? Well, they don't want to spend a ton of money. That's why they're doing a spread as opposed to buying calls outright. And they just want exposure to Amazon moving higher on earnings. So that was a pretty clear-cut trade that we saw. Now, on the flip side, in Amazon and also in a number of these big cap tech stocks, we are seeing a consistent amount of put selling. So, what does that mean? Well, either they would love to add more if these stocks ever do sell off, or they missed the rally and they want exposure lower. So we're seeing put sellers setting up a level where they would love Amazon to pull back and they could buy it at that price. But mostly bullish with the options side heading into earnings, not seeing a lot of hedging of this event.
Not a lot of hedging of this specific event. Maybe that's good news. I guess we'll find out in just a couple of days. But next week is particularly fun because in addition to a whole bunch of earnings, $16.8 trillion in market cap reporting just next week alone, we also have a lot of economic events. We have the Fed meeting, of course, and then we have the jobs report on Friday. That is quickly followed by Caterpillar actually coming out and taking the stage. And you write in your notes that actually there's a really interesting history there when those stars line up.
Yeah, we looked at the Caterpillar options earlier this week, and on the non-farm payrolls event, it's an industrial stock. It's got a lot of exposure to some of those macro events. It's been moving more recently than the options have been pricing in. Through a derivative daily note that my partner sends out, he highlighted that and think it's a pretty easy, short strategy. It's one of those things where, we don't necessarily know if Caterpillar is going to go higher or going to go lower. We kind of leave that up to our analysts or our clients. But we're telling you that the options look a little cheap.
The options look a little cheap. And so when you put that together, it sounds like this would be potentially a good time to actually scoop up some of that insurance.
Yeah, exactly. Once again, if you have exposure in Caterpillar, they look like you have an opportunity with those options. That's what we're highlighting to our clients right now.
And when you zoom out, not just when we're talking about a specific name, a specific stock, again, you think about all of the events that we have coming up next week, a really busy calendar there. How does one hedge that? Do you do that through a broader index? Do you do that through the tech index, for example? What typically is the best strategy there?
Yeah, we are not always pushing protection, but we do like to look at it tactically. You're looking at what's happened the first month of the year. We're looking at typically at an ETF if you want to have a macro hedge. You said it, between the FOMC and the non-farm payrolls and all the mega cap tech earnings and the job numbers, et cetera. And given what has happened in the NASDAQ so far this year, and even some of the late afternoon sell-offs that we've been seeing, the market looks a little bit tired here. We're just simply looking at the next week Qs, 420, 410 put spread. Not necessarily saying, we think the world's falling apart, but we do think that those who have been riding this wave higher in mega cap tech, this is a good time to look at a short-term hedge given all the events that we have next week.
So a short-term macro hedge there, and that kind of wraps back to what you were saying earlier about you take a look at the correlations right now, and it seems like that the stocks, the individual stocks, are really moving off of their own fundamentals rather than all together as a group. And does that typically happen around earnings periods, or is that something unique that we're seeing right now?
Well, both. It typically does happen around earnings season. However, it's much more extreme right now, and it's not just near term, 1 month correlation that's at the lows. 6 month, 1 year. This is implied correlation. So this is what the market is expecting to happen going out 6 months to a year. The options market is telling us we expect this, low correlation stock pickers market to continue throughout the entire year. So we typically do see correlation, expected correlation come in ahead of earnings, but it's much more extreme than we've seen, in the last at least 10 to 15 years.
All right, Chris, really enjoyed this conversation. Good luck next week. That is Chris Murphy of Susquehanna. And let's check back in on that drama that we're seeing with Spirit and JetBlue. Of course, Spirit stock slumping after JetBlue warned this morning that its deal with the low-cost carrier may be terminable. And Spirit now responding, saying that they believe there is no basis for terminating this deal. You take a look at how shares are reacting right now. You actually have JetBlue up a little bit, unchanged. We'll see how that wiggles around. But Spirit, it is a clear message. Shares down almost 17% right now. We will continue to follow that story. Still ahead, we'll also take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg. All right, time now for Social Climbers. A look at the stocks making waves on social media this morning. First up, Intel, the chipmaker, delivering a disappointing earnings forecast, really renewing doubts about a turnaround in the semi industry. Next up, T-Mobile, missing fourth quarter earnings, the news overshadowing a surprisingly strong increase in new subscribers. And finally, LVMH, the French luxury conglomerate, posting revenue surpassing estimates as wealthy shoppers treated themselves to pricey handbags and champagne. And of course, you can follow all of that on TREN Go on your Bloomberg terminal. Now coming up, a read on the restaurant industry. We're going to do that with Michael Osanloo. He is Portilla's CEO and president. Next.
Great questions.
Now, Eli Lilly, it was late to the obesity drug business, years behind its longtime rival, Novo Nordisk. But its new shot, Zepbound, is now expected to be the best-selling drug of all time.
When I look around this room, I can't help but wonder, is Ozempic right for me?
Ozempic has been around for several years now, and it was a treatment for type 2 diabetes. In 2022, it started entering the public consciousness.
Ozempic is great for people whose parents can't cook.
Like, shut the up. You're on Ozempic.
The biggest corporate beneficiary of the drug's popularity has been Novo Nordisk.
Ozempic's success has turned Novo Nordisk into Europe's biggest company, with a valuation of $450 billion. But a new contender has entered the ring.
Eli Lilly also now has a competing drug. It's called Zepbound, and it looks to be even more effective than Novo's drug, and it also is a little bit cheaper.
It's really set off a horse race between these two fierce competitors to see who will take the biggest part of this enormous market.
In In 2019, Lilly and Novo traded at comparable levels to the rest of the pharma industry. Since June 2021, when the FDA approved Wegovy, the stock's valuations have soared, tracking alongside companies such as Apple. They're being valued on how much they're likely to grow in the next few years.
So the obesity market was worth $2.5 billion in 2022. We estimate that this market could be in excess of $80 billion by 2030.
Because now we have two competitors in the space, it's just going to make the whole market bigger.
And that was a look at Eli Lilly's foray into the obesity drug business. And of course, the promise of weight loss drugs, it's had big impacts on everything from retail to restaurants. So let's talk about that now with Michael Osanlo. He is Portillo's CEO and president. And Portillo's, of course, is a fast casual restaurant brand that started back in 1963. And Michael, first question has to be on those weight loss drugs. The Ozempic effect is what it's being called. Do you think that's overblown, or have you seen any impacts on your business?
I think it's totally overblown. I think it's a fun narrative to propose, but I don't see any impact on our business. And it's I've had 100 people ask me this question. It's just not happening. This might be more of a coastal thing than it is a Midwest heartland kind of thing.
Okay, so maybe a coastal thing. I won't belabor the point then. Let's, though, talk about food prices, because you take a look at ground beef prices, you take a look at cattle prices. They've been surging, cattle prices in particular, close to an all-time high. How are you navigating that, and when do you think things will actually stabilize here?
Yeah, I'll tell you, we're already seeing some signs of stability going forward. So one of the things that we do is we try to buy whenever prices hit a certain window. And so we've been forward buying a little bit. We've got a great hedging program. But honestly, I think we feel optimistic that the prices will mitigate over the back half of the year, and we will not see inflation nearly as bad as we have in the past few years.
I want to talk about hedging a little bit more, because you told Bloomberg News in August that you had hedged more than 2/3 of your meat needs for the year.
Yeah.
Are you doing the same in 2024? What does the hedging program look like?
It's a little bit less than that right now, because we're, again, optimistic on the back half of the year, and we don't want to miss out on an opportunity. But we're fairly well covered for the first half of the year.
Okay, fairly well covered right now. But even with those hedges in place, is there a risk that you'll need to raise prices, especially when you think about all the geopolitical tensions really impacting supply chains right now?
It's a great question, and the reality is that we don't know till you know, right? Because we've been living in a very volatile, uncertain environment for the past several years. So I would prefer to not raise prices, but you just don't know. And so we'll see. I think that our value proposition is incredibly important, and I think we're at a really sweet spot right now with our consumers in terms of what we provide, the quantity, the abundance, the quality, and the price point. So, I don't want to price unless it's absolutely necessary.
You don't know until you know. That is true of many, many things. But you've also mentioned tight supplies for onions, for French fries. How is that panning out, and what are you doing about it?
Well, those things have actually improved. Our supply, the potato crop was better, the onion ring crop was better, and so again, we're seeing light at the end of the tunnel in terms of French fries, onion rings. Almost all of our commodities we feel more optimistic about than we certainly were this time last year or the year before.
When I look at the end of my tunnel, I also often see French fries there, so I totally understand what you're saying. But I want to talk a little bit about Portillo's stock price. It's been a pretty rough ride. You're down 17% or so over the past year. What do you think the traders are missing about your story?
I think we're getting caught up in some of the pessimism with interest rate fluctuations. If you just look at us versus the Russell 2000, it's a lot of what's happening. It's the same volatility that small and mid-cap stocks are seeing. I think and I think everyone's worried about interest rates. The reality is that we are a self-funding company. We're a little unusual in a growth company in that Our restaurants cash flow positive from the day we open them, and we have plenty of cash to build the restaurants, all the restaurants that we want. So we're not reliant on external markets for cash needs. I think investors, if they really think about that this is a company with a ridiculous amount of white space, very profitable box economics, and self-financing. I just think that's a unicorn in the restaurant industry.
And let's talk a little bit about expansion here, because I will note that you're expanding in areas such as the Sun Belt. You're entering states that include Texas, Arizona, Florida. And on this show in the past week, I mean, we've had some really interesting conversations about the real estate market. And typically those conversations are about how high mortgage rates are and how impossible it is to buy a house right now. But when it comes to expanding into a commercial business, how has that been faring?
It's actually great because what we're trying to do is we're going to high growth states, but we're also going to states and places where there's a lot of development. There's cranes going up. There's new development being built. And so we have access to wonderful real estate. Now, the other thing that's a little unique about us is given our footprint and the size of our restaurants, we're not typically competing against fast casual or QSR restaurant concepts for space. Crazy as it sounds, we compete against more like casual dining or even car washes. Like car washes like 2+ acres, that's kind of what we like. We find that we go head to head with them for real estate when we're looking at new spaces.
All right, fisticuffs with car washes there. I wasn't expecting that one.
Exactly.
Let's talk about looking forward. I mean, next week we have the jobs report, of course, and one of the interesting things about this economic cycle is just how tight the labor market has remained, even with the Fed hiking interest rates so aggressively. What has that meant for your own hiring efforts?
I think it's forced us to really live what I believe is a form of enlightened capitalism. Okay, so when we've been hiring in Denton, Texas, we had 400 people apply for jobs within the first couple hours that we were open, and it's because we're paying significantly above minimum wage. We're trying to create a fantastic work environment for team members who love working for us, who have great values and embody those values. And then, and my investors are thrilled about that because it pays for itself in reduced turnover, reduced training costs, and retention. So I think smart companies that are doing things like that genuinely invest in people, will thrive in this environment regardless.
And I'm looking through your notes, Michael. When it comes to hiring, I see that you are looking for ways to optimize operations and increase efficiencies. And I read that, I think AI.
You know, it's funny because we certainly are using AI in some, I think, provocative ways. We've deployed a new staffing model to make sure, because, in the restaurant business, you're busy, you're slow, you're busy. And so we are using AI in helping us staff our restaurants. Every restaurant's a little bit unique in their demand flow, but we are using AI to do that. And we're helping our general managers by deploying tools like auto scheduling so that the machine learning tells you here's where you should schedule, here's when you should schedule, and it's really paying dividends for us right now.
All right, Michael, got to leave it here. Really enjoyed this conversation. Come back soon. That is Michael Osanlo. He is Portillo's president and CEO. Now let's go back to these markets right now. Abigail Doolittle, standing by.
Well, we do have stocks turning higher. Earlier, we had been looking at the possibility of the first down day in 7, but right now we have the S&P 500 up ever so slightly. The NASDAQ 100 is still down, being weighed on by Intel and that disappointing first quarter guide, but it will be a race right to the end of the day. On the week, though, Katie, we firmly have stocks higher. The S&P 500 up more than 1% from a sector standpoint. The Vanguard Energy ETF having its best day since October of the best week, I should say, since October of 2023. We also have the Communication Services Index sharply higher. To the downside, home construction down 2.3%, and we also have the discretionary index perhaps down in sympathy with Tesla, down 1.8%. Overall, though, for earnings, we're seeing a lot of beats. Now, is this because numbers have been coming in so much? We don't know, but technology right now, we have 94% of the companies beating the bottom line estimate. Of course, we'll have some of those big names coming up next week and the week after, so let's see if that holds. Just one sector, communications, which is interesting because that is a part of the mega cap tech sector, just 20% beats there, but you can see a pretty good scorecard here so far for earnings relative to the bottom line.
Yeah, and it's early, so maybe communications will catch up. Abigail Doolittle, thank you so much. Now coming up, we'll hear from Robert Rubin, former U.S. Treasury Secretary about why he believes the U.S. is in a, quote, terrible place with regards to its federal deficits. This is Bloomberg. Well, we're diving into the current debt and deficit with Robert Rubin, former U.S. Treasury Secretary. He spoke to Wall Street Week's David Weston about what he learned when he was in the White House in 1993 and if those lessons can be applied today.
I think that the risks that we identified then, the multiple risks, are the same as they are today. I think that the risks are even greater today because our debt-GDP ratio is CBO estimates at about 100% right now. It's the highest in the history of the country except for 1946 and 47 when we were coming back out of World War II. I think the risks are enormous, and some of them are materializing already, like higher interest rates and effect on inflation, in part, not in full. And others haven't materialized yet, but I think they're out there and sooner or later will materialize if we don't correct our fiscal trajectory.
You talked about some of the market indicators and even forces that you saw in 93 that sort of pointed you in a direction, pointed President Clinton in the direction of really making the deficit a threshold issue. Are we seeing those indicators of those forces today in the markets?
I think that we are seeing the effects, but it's unfortunately from a political point of view, David, I don't think they're getting connected in a meaningful way with deficit reduction. Sure, interest. I mean, the 10-year was about, I think, 1.5%, say, 2 years ago, and now it's about 4.5%. Now, that's a lot of factors that go into that, but I think part of it is our fiscal situation and the effect that's had on inflation. I think it's been an aggravator of, or if you will, an effect on inflation. And I think there's a general concern about the imbalance between supply and demand for savings and the excess demand that's created by our deficits. But it's not, unfortunately, from a political point of view, I don't think the dots are being connected the way they were back in 92-3 when we acted. Well, 93 we acted, but 92 when President Clinton was putting his plans together.
There's a lot of talk these days when we talk about the Fed about the neutral rate and a debate about whether is the neutral rate higher. And I guess my question is, does the deficit and the debt normally, all those things being equal, drive the neutral rate higher?
I think over time. But I think you can also have a long period of time, and we had a long period of time, David, we had actually a long, long period of time, during which all this was having little effect. And then all of a sudden, the 10-year went, as I said a moment ago, from roughly 1.5 to roughly 4.5. And I've been around markets and these policies for 5 decades now. And there certainly are periods when you can have a long time when reality is out of, or what's happening is out of sync with reality. But that doesn't go on forever, and when it corrects, it can correct savagely. A good example was the Eurozone, the sovereign Eurozone crisis. For years, the Greek bonds traded, roughly speaking, parity, with give or take, with German bonds, and all of a sudden it exploded. And I think it's a good example of how what isn't sensible ultimately doesn't continue.
There's the politics of it, which I want to talk about. Before that, let's talk about the approach taken to it. Let's talk about, for example, the Biden administration. We can talk about the Trump administration if you want. Sure. But the Biden administration. When you were there back in the 90s, you came from Goldman Sachs. You had other people there who knew the markets pretty well. There was a healthy dose of how are the markets reacting to this? What does that do for us? Do we still have that, or is it more ideologically driven? Because some people think we've sort of shifted the orientation, particularly the Democratic Party, more toward protectionism, more toward populism.
Well, you've asked multiple questions, so I'll give you my view. I've given a lot of thought to this, and I know the people there pretty well. If you look at the proposals, but I want to respond to something you said that's a little different. Well, I'll get to that in a second. If you look at the proposals, the major policy proposals that President Biden made, they were all paid for in the proposals. Now, ultimately, they had to go through Congress, and when they went through Congress, they came out, some of them paid for and some of them not. I think he's actually pretty good on this. I think there are other issues where I might have a different view than he does, or maybe I would have an altered view rather than a different view. But I think on fiscal stuff, actually, he's got a pretty good sense of it. I think on the proposals, they had 3 major bills, IRA, CHIPS, and infrastructure. And in the original proposal, and then of course before that, Build Back Better. And all of those, if you look at this is correct, because I looked at them, in all of those, the proposals were fully paid for. They had to go through Congress, and in Congress, in some cases, they lost the pay-fors. You know, you mentioned, I've forgotten how you put it now before, but did you say populism or progressive?
Populism, yeah.
Yeah, populism. If you look at what is being referred to as industrial policy, and they refer to it as industrial policy, it's their label, yes. But it's not picking winners and losers. Now, it may be in the minds of some of those people, but if you look at those proposals, and I've talked to their people about this a lot, I think they actually make a lot of sense on a purely economic basis. They're externalities. They basically dealt with shortfall, with insecurities in our system, in our economic system, with respect to our economic security, our economic functioning, our geopolitical or national security functioning, that markets were not going to meet and had to be met by government. So that, I think, is not industrial policy in the traditional sense of let's pick winners and losers. It was let's fill holes that the private sector simply isn't filling, and those are holes of economic and national security.
So from your perspective, the overall approach you don't take much issue with.
No, I really don't.
So how do we end up with where we are, where we have increasing deficits and increasing debt?
Oh, well, wait a minute. What I talked about was the proposals.
Yes.
No, I think we're in a terrible place, David, because unfortunately, once you get to legislating, there isn't the will. There's a lot of talk, but the talk is always divided politically between the Republicans who refuse to raise taxes and the Democrats who won't deal with entitlements. Now, I think there is a reality to this, and that is I do think when we eventually get to doing this, or if we're going to do it after the next election, which the good Lord would hope we will, but I wouldn't bet on it, about 60% or something of the increase in the debt from 2000 to 2022 was because of the tax cuts. So if it hadn't been for that, the debt, instead of being 100% GDP, would be about 60%. Another way to look at it is exactly what I just said, which is